So in the second quarter of this year, a single company generated over 2.8 billion euros in revenue. And like, the crazy part is they didn't do it by shipping more of their flagship hardware.
Right, which is usually the whole point of a manufacturing company.
Exactly. I mean, they essentially made almost 3 billion euros just by selling, software updates and these modular physical tweaks to factories that they had literally just run out of floor space.
It's an incredible bottleneck. We're looking at a situation right now where the most advanced manufacturing facilities on the planet are they're hitting physical limits.
Yeah.
And because of that, they're paying absolute premiums just to squeeze like an extra few percentage points of efficiency out of the equipment they already have.
And the company collecting those massive premiums is ASML. If you want to understand where the global economy is heading, you have to look at the semiconductor supply chain. And if you want to look at the semiconductor supply chain, you kind of have to look at ASML. I mean, they build the immensely complex lithography machines that print the world's most advanced microchips.
They're essentially the sole toll booth on the highway to advanced computing, right?
That's the perfect way to put it, a toll booth. Like if a company like Intel or TSMC or Samsung wants to manufacture a bleeding edge silicon, they have to pay the toll.
Which is what makes their earnings calls unlike literally any other in the corporate world. We aren't just looking at a balance sheet today. We are looking at a high-resolution map of the future.
Yeah, a roadmap.
Exactly. The guidance they give tells us exactly what the heavyweights of the tech industry are planning to physically build over the next, 2 to 3 years.
So our mission today on this Talk Tickers Deep Dive is to decode that map. We're doing a comprehensive breakdown of the ASML Q2 2026 earnings conference call.
And this was a massive quarter.
It's massive. So for you listening, whether you are an investor trying to parse out the macro market signals, or maybe you're a technologist curious about the absolute edge of optical physics, or you just want to know what it actually takes to build the infrastructure for this whole AI revolution, we've got you covered.
We're going to translate all that incredibly dense engineering and financial jargon from this 9.3 billion euro quarter into clear, actionable insights.
We're going to get into the hidden revenue beats, the structural shift in how memory chips are made, the massive leap forward in next generation optics, and honestly, the operational gymnastics required to scale production when you're already building the most complicated machines in human history.
The sheer scale of what they're navigating right now is just staggering. I mean, they're operating at the subatomic limits of what is physically possible, while simultaneously trying to satisfy this unprecedented global economic demand curve that's just being entirely driven by artificial intelligence.
So let's jump straight into the scorecard. Let's understand the magnitude of this quarter, because if you're holding the stock, these numbers are what you care about. ASML reported Q2 total net sales of 9.3 billion euros.
Which, it's worth pointing out, actually came in above the high end of their own guidance.
Yeah, a solid beat. And out of that 9.3 billion, their net system sales, so the revenue from selling the actual lithography machines themselves, that was 6.6 billion euros.
And the split on that 6.6 billion is incredibly revealing.
Exactly. It was 51% going to the logic segment and 49% going to the memory segment. It's like almost a perfect equilibrium.
And that balance is critical for you to note because historically logic and memory have operated on slightly different cyclical rhythms.
Yeah, they usually don't boom at the exact same time.
Right. So seeing them both pulling this much weight simultaneously indicates a synchronized, industry-wide push for capacity. It's a land grab.
And when we look at the specific technology within those system sales, extreme ultraviolet lithography EUV, which is, the crown jewel of their portfolio, that accounted for 3.8 billion euros.
And crucially, that includes the recognition of one next generation high NA EUV system, which we are definitely going to tear apart technologically a bit later.
Oh yeah, we have to. It's fascinating. And then the remaining 2.8 billion euros came from non-EUV systems. So primarily their deep ultraviolet or DUV machines.
But the profitability metrics on those sales are where you really see the power of that toll booth position we mentioned.
The margins are just insane.
Right. Net income for the quarter was 2.9 billion euros. That translates to a net income margin of 31.3%.
Well, let me just repeat that for the listeners. They are retaining nearly a third of every euro that comes through the door as pure profit.
Exactly, which resulted in an earnings per share of 7.59 euros.
We are talking about heavy industrial manufacturing here, right?
Yeah.
Machinery that weighs hundreds of tons. But they are achieving software-like profit margins.
Yeah, it's unprecedented for a hardware company.
and their free cash flow reflects it, to 1.3 billion euros for the quarter. And they're actively distributing that capital back to you, the investor. They're paying a 1.88 euro interim dividend and executing 1.1 billion euros in share buybacks under their current 2026 to 2028 program.
So the surface level read here is a company that is just completely dominating its market.
But the real insight from this transcript, the hidden driver of this massive revenue beat, wasn't that they suddenly, shipped a dozen unexpected EUV machines.
Far from it. The upside surprise was entirely driven by a line item labeled installed base management sales.
Which sounds incredibly boring.
It does, but this segment generated 2.8 billion euros in a single quarter, coming in a full 300 million euros above their own internal guidance.
Right, so installed base management sounds like the most mundane corporate IT support phrase imaginable. Yeah. Like updating Windows or something. But driving almost 3 billion euros in a quarter means something wild is happening under the hood. Let me put some context around this for anyone who hasn't been inside a semiconductor fab. You can't just rent a warehouse in an industrial park and park an ASML machine inside it.
No. These clean rooms are arguably the most highly controlled environments on Earth.
We're talking about billion-dollar facilities. They have vibration isolation platforms drilled directly into the bedrock. The air filtration removes particles down to single-digit nanometers. And the temperature controls, they are accurate to a fraction of a degree.
Because if the temperature fluctuates even slightly, the materials expand or contract, and your nanometer scale precision is completely ruined. Building a new clean room takes years of planning. It's massive capital expenditure, intense regulatory approvals.
So the physical footprint of a modern fab is a hard, inflexible constraint in the short term.
Exactly. So if you are a major chip maker, say TSMC or Samsung, and the AI boom means your customers are just screaming for 10% more capacity this quarter, you can't just expand the building.
Right. Your factory floor is full. So what do?
You turn back to ASML.
And you basically ask them to overclock the multi-million-dollar machines you already bought. You pay them for massive software optimizations, modular hardware upgrades, and these yield improvement packages just to squeeze every last theoretical wafer out of the existing footprint.
It's the industrial equivalent of finding out your data center is out of server racks, so you decide to spend a premium to upgrade the processors and memory on every single blade you currently own.
I used the analogy the other day that it's like a PC gamer realizing they can't buy a next-gen graphics card yet, so they spend a fortune on water cooling their current rig just to squeeze out a few more frames per second.
That is a perfect analogy. And from ASML's financial perspective, this is highly, highly lucrative.
Because the heavy lifting, the casting of the massive steel chassis, the initial assembly in the clean room, the wildly complex shipping logistics that require a dedicated 747, all of that overhead was paid for years ago when the machine was first purchased.
Right. So delivering a software upgrade or swapping in a next-generation sensor module requires just a fraction of the overhead and material costs compared to building a new system from scratch.
So this surge in installed base management revenue falls almost entirely to the bottom line.
Exactly. It was a primary engine driving ASML's Q2 gross margins up to 54%. Management explicitly noted during the call that the inclusion of very high margin components within these customer upgrades was the key factor in the beat.
They're essentially selling high-performance digital and modular components to a captive audience that is desperate for throughput. But that desperation brings up a really crucial question. Why are the chip makers so desperate right now?
Well, we have to dig into the story behind the numbers to answer that. And we need to separate the logic side of the house from the memory side because the AI catalyst is affecting them in distinctly different, fascinating ways.
Let's start with logic, which, comprises the processors, the central brains of our computing architecture. ASML is projecting that their advanced logic foundry-related sales will grow over 25% this year.
And the transcript highlights two primary drivers for this. First, the aggressive ramp-up of the 2-nanometer node for high-performance computing and mobile applications. And second, the early foundational investments for the upcoming 1.4-nanometer node.
I think we need to clarify something important about those nanometer numbers right away, just for our listeners, because it's one of the most common misconceptions in tech, and it drives me crazy.
The naming convention, right?
Yes. When we talk about a 2-nanometer chip, we are not talking about a physical transistor gate that is 2 nanometers wide. That hasn't been the case for over a decade. A silicon atom is roughly 0.2 nanometers wide.
Right, so a 2-nanometer gate would be about 10 atoms across.
Which invites quantum tunneling issues where electrons just teleport across the barrier because the wall is too thin, the physics break down.
Yeah, the terminology has basically morphed into a marketing and density equivalent metric.
Exactly. So when a foundry says 2 nanometer, they mean the chip has the performance and power efficiency equivalent to what a theoretical 2 nanometer planar transistor would have delivered back when we actually measured things flat.
Right. And to actually achieve that performance, the architecture has fundamentally changed. We aren't just printing flat lines on silicon anymore. We went to FinFETs, which are these 3D fin-like structures.
And now for the 2 nanometer generation, the industry is moving to gate-all-around or GAA architecture.
Yes. They're literally stacking horizontal ribbons of silicon on top of each other and wrapping the gate material entirely around them to prevent current leakage at these microscopic scales.
It's wild. And constructing those insanely complex 3D ribbons of silicon requires an immense amount of precision lithography. I mean, the massive data centers being constructed globally right now to train next-generation large language models, they demand the absolute highest performance, most power-efficient logic chips available.
Because every watt of power saved at the chip level translates to massive savings in data center cooling and energy costs.
Exactly. That economic reality is pulling the 2 nanometer timeline forward, driving that 25% growth for ASML's logic systems.
A 25% growth rate in logic makes total sense when you look at the arms race between tech giants building out AI infrastructure.
But then you look at the other half of the business, the memory segment. ASML is projecting their memory-related net system sales to explode with over 75% growth this year.
A 75% increase in heavy industrial equipment sales is just staggering.
It's huge. And CEO Christophe Fouquet pointed directly to the tight supply, pushing up prices for DDR5 and HBM high bandwidth memory, which is triggering the construction of massive new megafabs.
So to understand why memory is growing at triple the rate of logic for ASML, we have to look at the architectural bottleneck of modern AI computing.
The memory wall.
Exactly. We often obsess over the processing power, the GPUs and accelerators, but a processor operating at blistering speeds is completely useless if it is constantly waiting for data to arrive. Large language models require terabytes of parameters to be held in active, incredibly fast memory.
It's like you can have the smartest brain in the world, but if it has a terrible short-term memory, it can't solve a complex math problem. It bottlenecks.
That bottleneck is known as the memory wall. And to break through it, the industry relies on high bandwidth memory, or HBM. And HBM is a marvel of engineering. Instead of laying memory chips flat next to the processor, which takes up space and increases the physical distance data has to travel.
And stack them.
Yes, they stack. The memory dies vertically, like floors in the skyscraper.
And they connect those floors using through silicon vias or TSVs. They literally drill microscopic vertical tunnels through the silicon layers to allow massive highways of data to flow up and down the stack directly into the processor.
The demand for these HBM stacks is unprecedented right now, but here is the critical nuance for investors. Simply building more of the same memory chips wouldn't necessarily cause ASML's revenue to spike by 75%, especially at the high end of their product line.
Right.
The true catalyst driving this massive revenue jump is a shift in what ASML calls lithography intensity.
Okay, let's unpack that term, because it sounds like jargon. What does a shift in lithography intensity actually look like on the factory floor?
Well, it means that to manufacture these next-generation memory chips, specifically transitioning to what the industry calls the 1C or 1B DRAM nodes, which involve shrinking the physical features below the 14-nanometer half-pitch mark, the fundamental physics of the manufacturing process have to change.
The memory manufacturers are basically hitting a wall with their older lithography tools.
Exactly. Huh. They are being forced to abandon a legacy technique called multi-patterning and adopt a process called single expose EUV.
This is where we need to dive into the engineering, because this transition is the bedrock of ASML's memory revenue explosion. Yeah. This is the actionable takeaway. Multi-patterning was essentially the industry's clever but agonizingly complex workaround for the limitations of older deep ultraviolet or DUV machines. Right. Let's say you need to print a dense grid of lines on a silicon wafer, and those lines need to be spaced 20 nanometers apart. But your older DUV machine uses a wavelength of light that is 193 nanometers. It physically cannot paint lines that fine and close together. The light blurs.
The brush is too thick for the canvas?
Yeah, exactly. So to use a multi-patterning workaround, think of it like a multi-pass printing press. The DUV machine prints a wider set of lines. Then the wafer goes through a series of complex chemical deposition and etching steps to essentially build spacer walls alongside those printed lines.
It's so tedious.
It really is. Then you strip away the original lines, leaving only the thin spacer walls. Then you might have to run the entire wafer through the lithography machine again, aligning it with subatomic precision just to print another intersecting pattern.
And that alignment requirement, what the industry calls overlay, is the critical failure point. If the second pass of the DUV machine is misaligned by even a fraction of a nanometer, the entire circuit is ruined. The defect rate, or edge placement error, compounds with every single additional pass.
It's slow, it requires dozens of extra chemical steps, it ties up factory space, and the yield, the percentage of actually working chips you get off wafer drops every time you run it through.
Yeah.
It is an economic nightmare for the fab.
And this is exactly where extreme ultraviolet, or EUV lithography, fundamentally changes the equation. EUV machines use a wavelength of light that is just 13.5 nanometers.
It's an incredibly fine brush.
Yes. It allows the chipmaker to print that incredibly dense 20 nanometer pattern in a single precise flash of light. One pass. Single expose.
You completely eliminate all those extra chemical deposition steps, the etching steps, and the terrifying risk of misalignment on multiple passes. The yield skyrockets and the time it takes to process a wafer just plummets.
But here's the thing. Historically, memory manufacturers resisted moving to EUV.
Why? Because of the price tag.
Exactly. An EUV machine costs upwards of 150 to 200 million euros. For years, the memory market was incredibly cost-sensitive. DRAM was treated almost like a commodity, so the memory makers preferred to absorb the pain and complexity of DUV multi-patterning because the massive capital expenditure of buying fleets of EUV machines would ruin their profit margins.
But AI changed the math. The margins on high bandwidth memory are currently so rich, and the performance requirements for these 1C and 1B nodes are so strict that the old multi-patterning workarounds are simply breaking down. They can no longer physically or economically achieve the density required using DUV.
Exactly. The memory makers have crossed the Rubicon. As Christophe Fouquet noted, this is the perfect storm for ASML in the DRAM space.
Yeah.
The manufacturers are aggressively buying these wildly expensive EUV systems to replace their convoluted multi-patterning lines. Lithography intensity, which is the amount of capital expenditure dedicated specifically to ASML's most advanced tools, is rising dramatically across the entire memory sector.
And that is why you are seeing a 75% growth rate. It is a structural architectural shift. They aren't just making more chips, they are fundamentally changing how the chips are made, and ASML literally holds the patent on the new method.
Which brings us to the next evolution of this technology, the technology that will dictate the next decade of computing. During the call, management was very keen to highlight a press release that actually dropped the exact same morning regarding their high NA system.
Yeah, the timing wasn't an accident. The announcement was from Intel Foundry. They officially confirmed that they are actively using ASML's high NA EUV technology on their Intel 18A process node to produce a subset of their new Intel Core Ultra Series 3 processors.
Furthermore, ASML guided that they expect to recognize revenue for 4 to 5 of these high NA systems in 2026.
To appreciate why this Intel announcement is such a massive milestone, we have to look at the sheer physics and logistics of high NA. NA stands for numerical aperture, which is essentially a measure of how much light a lens or mirror system can collect and focus. Standard EUV has an NA of 0.33. High NA increases that to 0.55.
It sounds like a small numerical bump, right? But the engineering required to achieve it borders on science fiction.
It really does. Producing EUV light at 13.5 nanometers is already one of the most difficult engineering feats in history. You cannot use normal lenses because almost all materials, including glass and air, just absorb EUV light.
So the entire machine has to operate in a hard vacuum, and it uses a series of incredibly precise, multi-layered mirrors to bounce the light.
And just generating the light, I love this part, requires dropping microscopic droplets of molten tin into a vacuum chamber, hitting them with a low-power pre-pulse laser to flatten them into a pancake shape, and then immediately blasting them with a massive high-powered CO2 laser to vaporize the tin into a plasma that emits the 13.5 nanometer light.
And this happens 50,000 times a second.
It's mind-blowing.
It is. Now, to achieve high NA, to collect a wider angle of that light and focus it tighter to print even smaller features, the mirrors, which are manufactured by their partner ZASS in Germany, had to become significantly larger and more complex. In fact, they had to adopt what are called anamorphic optics.
Okay, and this is where it gets incredibly tricky for the chip makers. because the mirrors are bouncing the light at much steeper angles.
Yeah.
If they use standard magnification, the light would hit the reticle, the blueprint of the chip and reflect back on itself, ruining the image.
Right. So the anamorphic optics actually magnify the image differently in the X and Y axis. They shrink the image by 4x in one direction and 8x in the other.
Which means the chip makers have to entirely redesign how they create the masks and blueprints for their chips to account for this distorted magnification. It is a massive technical hurdle.
Not to mention, the machines themselves are physically gargantuan. They are the size of a double-decker bus. Moving them requires specialized transport infrastructure.
Because of all these immense hurdles, the anamorphic optics, the size, the cost-high NA, has been viewed by some industry skeptics as, a bit of an incredibly expensive science experiment.
Yeah, there were doubts.
The question was always, yes, this works in a pristine R&D lab, but can a foundry actually integrate anamorphic optics into a high-volume commercial manufacturing line without destroying their profit margins?
And that is exactly what the Intel press release validates. It proves that High-NA has crossed the chasm from experimental prototype to commercial viability. It is actively printing wafers that will be packaged into consumer laptops and servers. The technology works at scale.
Which is a huge buy signal if you're looking at ASML's long-term moat. While High-NA is the future, the current generation of EUV is also undergoing a massive transition. And this leads us into a fascinating economic dynamic.
Yeah, this part is really interesting.
In the transcript, management talks about phasing out their older D models this year. Next year, the production mix will be entirely composed of faster E and F models, specifically the 3800E and 3800F.
It's essentially an alphabet soup of upgrades, but each subsequent letter represents a step function increase in productivity. The D model was a workhorse, but it has reached its physical limits in terms of how many wafers it can process per hour. The E model introduces faster stages and better light source efficiency, and the F model pushes that even further.
But this brings up a mathematical quirk from the Q&A session with the analyst that I really want to explore. CFO Roger Dassa noted that while ASML plans to increase the number of machine units shipped next year by 30%, the actual increase in productivity, the total wafer capacity delivered to the customer, will jump by 45%.
Right, because the new E and F models are inherently faster, shipping 30% more physical boxes delivers a disproportionate 45% leap in industrial output.
The math is straightforward. The machines do more work in the same amount of time. But think about the logical conclusion of that math.
Okay.
If I am a construction company and I need to move 1 million tons of dirt, and you invent a bulldozer that moves dirt twice as fast, I'm only going to buy half as many bulldozers. Right. So if ASML's new machines are so much more productive, doesn't this massive leap in throughput eventually cannibalize their long-term sales volume?
Yeah.
If the customers get 45% more capacity, won't they eventually need fewer machines?
It is a highly rational concern, and it is exactly why the analysts pressed management on this dynamic.
It's the first thing I thought of.
If ASML operated like a traditional commoditized hardware company, your bulldozer analogy would be perfectly accurate. If they priced their machines based solely on a cost-plus model, meaning they calculate the cost of the steel, the glass, and the labor, and add a flat 20% markup, then building faster machines would absolutely cannibalize their future revenue.
So how does ASML avoid this trap? Because clearly, they aren't worried about it.
They utilize a strategy called value-based pricing. ASML does not price a lithography machine based on what it costs to manufacture. They price it based on the immense economic value that the machine generates for the semiconductor fab over its lifespan.
Okay, we have to look at the economics of the fab again. The biggest expense for a semiconductor manufacturer isn't necessarily the raw silicon, it's the depreciation of the multi-billion-dollar clean room and the equipment inside it.
Precisely. The clock is always ticking. A fab has to maximize the number of sellable chips it can produce per square meter of cleanroom space per hour. If ASML delivers an F-model EUV machine that can process 15% more wafers per hour than the older D model, it means the chip maker can generate significantly more revenue without expanding their physical footprint.
It saves them billions in capital expenditure and depreciation costs over the long run.
And ASML looks at that massive value creation and says, we aren't going to give you that 15% boost for free.
Exactly. Under value-based pricing, ASML justifies a significantly higher average selling price, or ASP, for the E and F models. They capture a large portion of the economic value generated by that extra productivity.
And the customer is willing to pay the premium because the return on investment is still incredibly strong, given their space constraints and the demand for AI chips. So ASML isn't cannibalizing themselves. They are structurally elevating the pricing and margin profile of the entire industry. They share the economic upside of the innovation with the customer.
That answers the cannibalization question perfectly.
Yeah.
And, during the Q&A, an analyst specifically asked if customers might choose to just buy upgrade packages for their older E models rather than shelling out for the brand new, more expensive F models.
Oh, yeah. And management's response was essentially that the market demand is so ferocious right now, it isn't an or question. It is an and question.
Yeah, they want it all.
The customers want to upgrade every single legacy machine they own, and they want to buy every single new F model ASML can possibly roll off the assembly line.
The appetite for capacity seems almost boundless, which pivots us into the massive challenge ASML faces. How do you physically build enough of these systems? Let's examine their forward guidance. For the full year of 2026, they raised their guide to between 43 and 45 billion euros in sales, maintaining that elite 54% to 56% gross margin.
They anticipate shipping roughly 65 low NA EUV systems, which is greater than 45% growth in that category alone, and over 130 DUV immersion systems.
I want to briefly touch on a geopolitical reality mentioned in the transcript regarding those DUV numbers, just to be completely impartial here. Management noted that sales to China are expected to remain steady, comprising around 20% of net sales for the full year.
Which is a vital data point, given all the intense global focus on export restrictions.
Right. And the transcript was clear that this baseline is driven by solid, ongoing demand for mainstream trailing edge logic. We aren't making a political judgment here. We're just looking at the facts presented in the call.
It is a critical distinction. The export controls generally restrict the absolute bleeding-edge technology, the EUV systems, and the most advanced DUV immersion tools capable of sub-7 nanometer logic. However, there is a massive global economy that does not run on 2 nanometer AI chips.
Exactly. If you are building an electric vehicle, a solar inverter, or billions of connected IoT devices, you don't need a 2 nanometer processor. You need robust, highly reliable chips manufactured on mature nodes, like 28 nanometer or older.
And those mature nodes rely heavily on DUV lithography, both RF immersion and KRF dry systems. The demand from China reflects a strategic build-out of capacity for these foundational mainstream chips. ASML views this 20% revenue share as a structural, steady baseline of global demand that operates in parallel to the high-end AI arms race.
It is a fascinating dual-track market, but the real fireworks in the transcript happen when management starts talking about the 2027 and 2028 capacity scramble for the leading edge.
Yeah, this is where it gets crazy.
For 2027, management explicitly stated that their low NA EUV order book is effectively full. They are completely sold out.
Done. Booked.
Consequently, they are executing a massive 30% capacity expansion for low NA EUV and DUV immersion systems for 2027, and it accelerates from there. The demand signals for 2028 are so overwhelming that they are already investigating another 30% capacity expansion, targeting an output of around 110 low NA tools for that year alone.
The numbers are easy to read on a spreadsheet, but we have to pause and consider the operational reality of what is being proposed here. How do you scale production of the most complex optical machinery ever devised by 30% year over year, twice in a row?
This is exactly what I wanted to dig into, because as we established earlier, you can't just flip a switch on an assembly line. These aren't cars. And crucially, management explicitly stated they are not waiting to build entirely new factories or new physical campuses to achieve this near-term scale-up.
Right.
They are planning to extract this massive volume increase out of their existing physical footprint. How is that mechanically possible?
It requires an absolute masterclass in industrial engineering and operational gymnastics. When the analysts pressed them on the logistics, CFO Roger Dassa detailed a three-pronged approach happening inside ASML's facilities right now.
Okay, let's hear it.
First, they are aggressively reallocating real estate. Currently, some of their ultra-clean manufacturing cabins are dedicated to R&D. They house prototype systems where engineers run tests and experiment with future architectures.
And those engineers are essentially getting evicted from the prime real estate.
Exactly. Management stated they are finding another home for the R&D prototypes. The goal is to dedicate 100% of the pristine Class 1 manufacturing cleanroom space solely to commercial revenue-generating output. Every single square meter of that facility must be printing money.
Okay, so you reclaim some floor space, but that only gets you so far. The second prong Dassa mentioned was ruthlessly attacking cycle times.
This is about workflow optimization. It takes months to assemble, test, and calibrate an EUV system. ASML is implementing advanced modular building techniques. Instead of building the machine linearly from the ground up inside the main clean room, they are pre-assembling and pre-qualifying highly complex submodules in secondary locations.
Ah, I see.
When those modules arrive at the final assembly cabin, they integrate much faster. Shaving a week off the assembly time of a single machine when extrapolated across the entire fleet yields a massive increase in total annual output.
But no matter how fast ASML turns a wrench, they are fundamentally constrained by their supply chain. I mean, they don't manufacture the optics, they don't manufacture the highly specialized lasers. If you build a chassis 30% faster, but the mirrors haven't arrived from Germany, the machine still can't ship.
And that is the third and perhaps most vital element of the scale-up. ASML is heavily reliant on their supply chain partners, particularly ZISS, who manufactures the optical lenses and mirrors.
And those mirrors are insane.
The production of these optics involves polishing glass to such a degree of perfection that if the mirror were the size of a country, the tallest mountain would be a fraction of a millimeter high.
The lead times on creating those optics are measured in years, not months. You have to literally pour the specialized glass and let it cool over massive periods of time to prevent any internal stress or deformation.
Exactly. So how is ZSS meeting this sudden 30% jump in demand? They're doing it because ASML and ZISS foresaw the trajectory of this industry years ago. They made foundational strategic investments in new glass pouring facilities and polishing capacity well before the AI boom truly accelerated.
Talk about long-term planning.
What we are seeing now in 2026 is ASML essentially cashing in the chips on strategic bets made nearly half a decade ago. They are leveraging that past supply chain investment to drive this volume increase without having to wait to pour new concrete today.
It is a remarkable convergence of maximizing real estate, optimizing the industrial workflow through modularity, and reaping the rewards of long-term supply chain planning. And if we zoom out, this level of long-term visibility is just historic for this sector.
Very unusual.
Taking hard orders and planning aggressive capacity expansions for 2028 in the middle of 2026 is a complete paradigm shift.
Historically, the semiconductor equipment industry has been notoriously cyclical. It was a boom and bust environment closely tied to short-term consumer electronics cycles.
Right. You buy a new smartphone, chip demand spikes, fabs order machines. The macro economy cools down, smartphone sales drop, the fabs cancel their orders, and the equipment makers suffer.
But this earnings call paints a very different picture. The industry seems to be decoupling from that short-term consumer cycle. Driven by the insatiable compute demands of AI, the massive shift towards sovereign technological investments where governments are subsidizing domestic fabs, and the broader electrification of the global economy.
It's all secular trends.
Exactly. Semiconductor manufacturing has evolved. It is no longer just about next quarter's consumer gadgets. It is a massive, multi-year strategic infrastructure play. Chip makers are building decade-long roadmaps. They view advanced lithography capacity not as a variable cost, but as critical national and corporate infrastructure.
And ASML's fully booked 2027 order book is the most tangible proof of that structural shift. Which brings us to the ultimate synthesis of this deep dive. If you're an investor, this is the part you've been waiting for.
The bottom line.
We've unpacked the incredible physics of EUV, the massive demand signals from the AI boom, and the operational gymnastics required to meet that demand. But what does it all mean for the financial mechanics of ASML as a business entity? Because the numbers they project for the end of the year are striking.
Fair.
In Q4 2026, ASML is implying an exit gross margin of roughly 56% to 58%. They're growing their top-line revenue by 35%, but their operating expenses, their OPEX, are barely rising. The business is fundamentally becoming much more profitable at scale.
It boils down to a confluence of mechanical drivers that are all aligning simultaneously. We can visualize this as a four-pillar gross margin engine that is currently firing on all cylinders.
Let's clearly define those four pillars based on the entirety of our analysis today. Pillar 1 is the product mix shift. As they phase out the older D models and transition the bulk of their EUV shipments to the higher-priced E and F models next year, the value-based pricing model dictates a higher average selling price and a richer margin on every unit sold.
Correct. The machines deliver vastly more economic value to the customer, and ASML captures a premium for that capability.
Pillar 2 is the sheer volume jump in their DUV immersion tools. While EUV captures the imagination with its subatomic physics, these immersion tools are the highly optimized, mature workhorses of the industry. Scaling up their volume by 30% adds a massive tranche of highly profitable, reliable revenue to the balance sheet.
The R&D for those platforms was amortized long ago. Pumping out higher volumes of mature technology is highly accretive to the overall margin.
Pillar 3 circles back to the hidden beat we discussed at the very beginning, the installed base management. Selling sophisticated software upgrades and high-margin hardware modules to fabs that are completely space-constrained is pure margin fuel. It requires minimal overhead, but delivers massive value.
It is the ultimate recurring revenue stream, supercharged by the physical bottlenecks of the customers.
And Pillar 4 is the reality of their operational scale-up. Building 30% more machines inside the exact same physical clean rooms provides massive fixed cost coverage. If ASML's facility costs, heating, cooling, and basic overhead remain static, but they manage to assemble 30% more systems under that same roof, the overhead cost attributed to each individual machine plummets, significantly expanding the gross margin per unit.
That fourth pillar serves as the perfect introduction to the broader financial concept of operating leverage, which dominated the analyst Q&A session.
Yeah, CJ Muse was really hammering this point.
Right. An analyst named CJ Muse probed deeply into this dynamic. ASML is projecting a 35% growth in revenue, yet their operating expenses, specifically R&D and SG&A, which is selling, general, and administrative expenses, are growing at a mere fraction of that rate.
So they aren't matching their revenue growth with a massive linear hiring spree.
Precisely the opposite. Management articulated that they do not need to drastically bloat their headcount to execute this aggressive technology roadmap. They recently underwent an internal reorganization to streamline processes and break down silos. They believe they can extract significantly more innovation and output from the world-class engineering teams they already have in place.
So mechanically, what does operating leverage look like on the income statement for someone looking at the stock?
It means that when ASML's revenue grows by €1 billion, their fixed costs and payroll remain relatively flat. Therefore, almost every single incremental euro of that new revenue bypasses the expense lines and flows straight down to the bottom line as pure profit.
That's incredible.
The profitability compounds dramatically. ASML has positioned its corporate structure to capture a vastly disproportionate share of the economics generated by this capacity boom.
So let's draw this all together. Talk ticker style, here is the actionable summary. ASML is sitting atop an absolute goldmine of structural demand. They're completely sold out for 2027 and are physically reorganizing their factories to squeeze out enough capacity to meet the surging demands of 2028.
Yeah.
The AI boom hasn't just increased the sheer volume of chips required. It has triggered a frantic, space-constrained land grab for capacity, forcing a fundamental shift in lithography intensity. Memory makers are abandoning old multi-patterning techniques and aggressively buying EUV machines just to keep up.
And through it all, ASML stands completely alone. By utilizing intelligent value-based pricing, cultivating a highly lucrative upgrade cycle for their existing fleets, and exercising ruthless operating leverage, they are capturing maximum value from their position as the undisputed toll booth of the global AI transition.
It is a remarkable portrait of a company operating at the absolute limits of physics and economics. But we don't want to leave you with just a neat summary. We want to leave you with a structural question to ponder something that wasn't explicitly debated on the earnings call, but casts a long shadow over everything we've discussed today.
It is the ultimate question of constraint, really, the logical extension of the roadmap they have laid out.
We spent this time detailing how ASML is achieving this massive 2027 and 2028 scale-up by ruthlessly optimizing their existing footprint. They are evicting R&D from the clean rooms, they are shaving days off cycle times, and they're cashing in on glass and optics investments made by suppliers half a decade ago. It is a masterstroke of execution.
Yes.
But what happens in 2030?
When the low-hanging fruit of operational efficiency has been picked completely clean.
Exactly. When you can't shave another hour off the assembly time. When the world inevitably demands the transition to sub-1 nanometer architectures, requiring fleets of high-NA machines that are even larger, vastly more complex, and demand even more power.
Will the physical reality of factory space, the unyielding laws of anamorphic optical physics, and the sheer logistical limits of the global supply chain finally place a hard, unbreakable speed limit on the global AI revolution?
Can the toll booth keep widening the highway forever, or do we eventually run out of concrete? Something for you to mull over. Until next time on Talk Tickers.